Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Many people have probably heard the term a two-bar reversal or a failed setup or a failed signal. Failed signals happen relatively immediately. So after one or two bars, if you don't see the failed setup, you should be able to build the confidence that the market's going to go in your direction. That's another issue that I find a lot of traders have, is they don't know how to hang on to winners long enough, or perhaps they get out of their trades a little too soon. So in understanding candlestick relationships and candlestick patterns may help you a little bit better in making those trade decisions. Some of my other favorite patterns, like the bearish engulfing. First off, it is another one of those open-close relationship setups, whereas you notice in this candle we have the market opens closer to the high and then closes below the open and closes closer to the low. Notice that it not only engulfs the real body, it also engulfs the range. The open close value is greater or consumes the prior candle's range and real body within its range of real body value. Do you see what I'm pointing out to? So the bearishness and the higher probability of a bearish engulfing pattern is if it engulfs more than one time period. The more time periods it engulfs, the more powerful the setup and the signal. And with the bearish engulfing, it's also critical to look for follow-through. We don't want to see the market within one or two bars immediately reverse and create an equal opposite, because then that would negate the negative value that the bearish engulfing signifies. So virtually, it's very interesting to look at both open and close relationships when utilizing candlesticks. And I think a lot of people are really trying to study the patterns rather than looking at what the market itself is telling you by the colors and the shapes, and looking at the four common denominators that each and every one of us have equal access to. And once again, those common denominators are simply the open, the high, the low, and the close. Now, it's interesting to note that for stock traders, and I know we're talking about foreign currencies, and we're here to talk about the euro currency and the British pound, and I'm going to get to that in a minute. It's interesting to know that in what we've just discussed with the open, high, low, close relationship, how many different ways there are and combinations there are to analyze markets via those four common denominators. Most indicators are built on one or the combination of those, and such as CCI uses the high-low close divided by 3. It's an actual moving average of the pivot point, the CCI indicator. If you look at stochastics, it takes a look at the close as it relates to the overall range of X amount of periods. Generally, it's a 14-window look-back period. Almost every indicator out there is built on the relationship of open, high, low closes. And it's even interesting how we could take a look at the stock market, how we could take even just 6 pieces of information that we find in our morning newspaper even. The number of, when you look at the stock market, think of all the indicators that were built on just maybe looking at volume, looking at advancing issues versus declining issues, the number of, let's say, new 52-week highs versus new 52-week lows. Looking at advanced versus declining volume. I mean, McClellan oscillator, looking at the AD line, advanced decline line. Look at, some of the pioneers that developed indicators. It is amazing to me, of all the indicators that are built out there, they're all designed around just 4 to 8 simple, amazing points of interest and that every one of us have equal access to. So there's different ways to skin a cat, they say. There's different ways to analyze a market. The key is if you understand how to properly use the indicators to your advantage. And I think that's one of the things that candlesticks are most often overlooked, that people fail to look at that open-close relationship, or the close as it relates to current and also past price action. So that's what I have to take to give, and by looking at a simple candlestick analysis. In looking at the ISE's spot euro currency index, and this is quoted in terms of euro to the US dollar. I mean, it's interesting to note that we do see at the bottom a simple equal opposite engulfing pattern. Notice that in longer term patterns that we see potential head and shoulder patterns, which we have not discussed today. But one of the patterns that is interesting is, we see this market, we see a little rally, you look at pullbacks, and here we have this one little doji all by itself. What's interesting here is this is the one situation that the next session, even though the market doesn't close closer to the high, look where the close is as it relates to the doji's high. So by looking at individual candle patterns, we can take some clues in the market, but it's a lot better if we utilize other indicators to help us identify confirming or confirmation behind what we see within the candle patterns. And by the way, I said earlier that if the market gets down to around this 126.5 area, I'd be looking to be a market, because one of the reasons is that's an area of old, what is this? Support, resistance, resistance, support, and it should, if it pulls back into this area, offer us another buying opportunity, a pullback. So that's what I say between 128 and 126. Just look at this area. This was a pullback. After the market broke out, it pulled back, so it's offering us all this area. Any trader that missed this whole move up here, they're going to be looking for pullbacks right into that zone. And I see that based on old price action as I'm circling on the chart here. And I think that that's one way to look at the market. And I told you when we first began looking at the euro currency, I said I'm going to go into by looking at what we're going to talk about today, and I'll show you how and why I would say in the next, now this probably isn't going to happen in the next day or two, but in the next 4 to 6 weeks, if we do see any further weakness, I would say this 126, 127 area should offer superior support in the marketplace, and that's what I'd be looking for as a buying opportunity on any substantial pullbacks. And I think towards year end, from a seasonal perspective, we see rallies going into the year end. So I think we want to see some weakness through at the end of August into September. And as we get into September, if we do see that pullback in 126, do keep and pay attention. And I'm just giving you a setup a few weeks in advance, something to watch for. Watch for that 126 handle area for a buying opportunity, all right? I think you're obviously looking at, you don't have any unfinished business. They came down, they filled the market, filled the gap in here. There's no unfinished business. We're going to come back down. We'd fill this area here. In fact, some technicians would even call this a cup and handle pattern if we pull back down in this area. So there we have a complete diagnosis of the market on the euro currency based using just candle and past price action.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.